Hello. We're going to look at tax policy concepts just so that we have the language that we need to deal with and the concepts we need in order to effectively engage with taxation this semester. So, tax policy basically, these are considerations that are used in evaluating whether a tax is good or not. The idea is that we have various things to use for evaluation, but if we were to take the sum total of them all and try to achieve every single one, the odds are pretty good it's not going to happen. In fact, I don't think it's possible to achieve a particular tax provision that has met every single tax policy goal. But when we look at deviations from good tax policy, from these tax policy goals, we want them to be for a reason. We want them to be evaluated and the trade offs considered. So, violation of a tax policy norm isn't necessarily the end of the world as long as there is an appropriate policy goal that balances it out and, in fact, is more important than the tax policy norm. The key here is that there is actually an evaluation that is done. Okay, so um, this goes back to Adam Smith, Wealth of Nations, 1776. It's not just part of Hamilton. It is the year that Wealth of Nations was, in fact, published by Adam Smith, the father of mercantilism. So this is where I go total econ geek. But anyway, Adam Smith, in his Wealth of Nations, actually wrote about what it would take for something to be a good tax. And I have a couple of quotes from the actual book itself. Ability to pay. The subjects of every state ought to contribute toward the support of the government as nearly as possible in proportion to their respective abilities. So basically, he was saying that taxes should be proportionate to how much a person benefits from living in society. When you think about that, who benefits more from society? Is it the wealthy or the poor? And when we think about that in terms of a dollar amount, it actually turns out to be the wealthy. I have people some years try to tell me that it's the poor because they get welfare. But in reality, when you think of the machinery of the state, it's actually set up to protect the assets of wealthy people, the entire judicial system, civil judicial system, that's to protect the wealthy. The infrastructure, it's something that's used more by the wealthy than it is by the poor. Even the roads, if you don't have a car, you don't use the roads anywhere near as much. If you are thinking about our financial system and how it's actually a fairly strong financial system that's set up to protect rights, well, if you don't have any savings, it doesn't matter to you. So again, when we think about the benefits that a wealthy person has from society versus a poor person, we actually find that the wealthy people do, in fact, get more benefit from society. Now, this ability to pay, it centers on the idea that if you are able to pay, and a buck is a buck, it doesn't look at a difference between, well, I earned mine from labor, you earned your dollar from investments, so we should treat them differently. A buck is a buck, okay, when we're evaluating ability to pay with Adam Smith. Okay, another thing that Adam Smith said is the hallmark of a good tax is that it is predictable and it's simple. So I should be able to predict what my tax liability is. I should be able to easily comply with it. I should be able to figure it out without actually having to go to a great deal of trouble. Nor should it be arbitrary. I should be able to make decisions based on what the taxes are, and they shouldn't be changing around me all the time to make my planning moot. This is a pretty important one. Number three is convenient for the taxpayer. It ought to be levied at the time or manner which is most convenient for the taxpayer. Most of our taxes are collected through withholding on our wages, and that's pretty darn convenient. That's something that I think Adam Smith would kind of like here is the withholding system because it doesn't allow you to for it to be inconvenient. If we can think of what would be inconvenient, well, asking for payment for the entire year all at one time, specifically after, year end, I suppose would probably be a bad idea. Oh, look, it's Christmas. Everybody had to blow money for it. No money left. So convenience is something that matters. Now, number 4, I used an economic term here. It says limit deadweight loss. Deadweight loss is the economic idea of things that I didn't need to pay for, that didn't generate anything for me. So every tax should be contrived as to take out and keep out of the pockets of the people as little as possible. So we shouldn't overtax them just for the heck of it. We should minimize collection costs. So when you're looking at streamlining the machinery of collection, it should be efficient. You shouldn't have any more than you absolutely need. Then again, you also shouldn't have less than you actually need. Taxes can discourage industry. It can lower the production that you would see in many industries. So we don't want to overtax as well, because you're probably going to end up with less taxation, because you can encourage non-compliance, i.e. black market stuff. Remember that we have a voluntary system where we voluntarily report. Yes, they try to keep us honest because they do have paperwork, but not everything is easily had by cross-referencing. So they don't necessarily know everything we do. So when we look at the higher the deadweight loss, if we lose faith in our system, we're actually going to have more non-compliance, which will lead to even more, because it will be a cycle of, well, if they're not doing it, I'm not doing it. Okay. And the other thing too is we want to minimize compliance costs. I said minimize collection costs. Now that's on the government side. When I say minimize compliance costs, how much time and effort should you have to actually put in to figure out your taxes every year? We want to keep those costs fairly low. It shouldn't cost you an arm and a leg to figure out which arm to hand over to the government. Okay. So now I'm going to kind of bring you up to date. So we just jumped from 1776 to right now. And there are a few tax policy concepts that I'm going to introduce here. This is not the sum total of all tax policy concepts, but it's a starting point. Okay, so we've got equity, we've got neutrality and distortion, which are actually flips of each other, diametrically opposed, and simplicity / administrability. So when we deal with equity, okay, there are 2 main types of equity that we talk about in the tax context. One is horizontal equity, the other one is vertical equity. Horizontal equity is the idea that similarly situated taxpayers should bear an appropriately similar burden. Okay. Vertical equity deals with dissimilar taxpayers and that they should bear appropriately dissimilar burdens. Now, I also have intergenerational equity down on here. This is something that's often brought up when you're dealing with politics and dealing with particular tax provisions, but it's not quite the same. But I just want to put it out there. The idea of intergenerational equity is essentially that you shouldn't put off paying for something on future generations unless they're going to get as much benefit out of it as you are. For example, the national highway system. That is something that it would be appropriate for somebody down the road to also bear cost of, because it's provided massive benefits over multiple generations. But a lot of tax cuts, for example, are irresponsible because they're essentially, to the extent that we're generating deficits that our children have to pay, then we are offloading the costs onto the next generation. So neutrality and distortion, like I said, are flips of one another. Neutrality is the idea that a tax provision should not be pushing you to a particular type of behavior when there's equal choices. For example, do I choose debt or do I choose equity when I'm trying to set up my business? Okay. Distortion is the flip side, which is that tax policy actually pushes you in one direction over another. If you have two similar types of options and one is tax preferred and the other one is not, then tax policy would be pushing you toward the one that is tax preferred. So when we are looking at a tax preferred option, it's not a neutral provision. It is trying to pick and choose favorites. It's trying to actually change the market. It's trying to make choices. And a lot of tax provisions are deliberately distortionary because they're trying to get you to make a choice, trying to get you to pursue a particular type of activity. So when we look at neutrality, again, we don't want the tax system to be playing favorites. We want it to just leave it for the market to decide. And simplicity and administrability, these ones are fairly simple. I think I already referred to it in the Adam Smith part of this micro lecture. But simplicity, we should be able to figure out what we owe without undue compliance burdens. And administrability, it's something that should be easy for the government to actually put into place and to be able to enforce without investing huge amounts of money and without actually having to spend a lot of what they get from us in order to go after more. Okay, so I want to discuss equity just a little bit more. So I have this triangle. You'll notice low income, medium income, and high income earners. You'll notice that low income at the bottom, it's the widest part of the triangle. That's to represent the fact that there are more low income taxpayers than there are medium income, and there's more medium than there are high income. So it is a pyramid when we're dealing with number of people versus income levels. Okay, so horizontal equity, it is the idea that low income or that similarly situated taxpayers bear an appropriately similar burden. So what that does is it looks at people in the same bracket, if you will, the same similarly situated circumstances. So it's pretty easy. If I make 15,000 and you make 15,000, we'd expect to pay pretty much the same burden of tax, right? Now, the problem with both horizontal and vertical equities is it gives us these ideas, but it doesn't draw any lines for us. What does similarly situated mean? Okay. It's easy to say we're similarly situated if we make the exact same amount. If I make 15,000 and you make 15,000, we're similarly situated. Duh. But what if I earn 12,000 and you earn 15,000? Are we still similarly situated? No. What if I earn 15,000 and you earn 20,000 and you have 10 kids? Are we still similarly situated? So essentially, when we're looking at similarly situated, I think we generally are fumbling toward the idea of disposable income. Do we have the same level of disposable income? When we're looking at low income families, they generally are just spending all of their income on basic necessities: food, shelter, um, clothing. Okay. And there may be some of these needs that are left unmet because there is a deficit when it comes to being able to pay for all of it. So when we're looking at this horizontal equity, it's looking at people within the same pyramid bracket and trying to determine whether or not they're being equitably treated relative to one another. If I earned 15,000 and you earned 15,000 and I didn't have to pay any taxes and you did, that really wouldn't be equitable. And again, another word for equity is fairness. So that would not seem fair. As I said, though, these concepts don't give us the tools to set the dollar amount that determines comparability. That is something for us to decide. Now, vertical equity is, instead of looking within a band, it's comparing two different bands. It's looking at, we want vertical equity to look at the idea that dissimilarly situated taxpayers are bearing an appropriately dissimilar income tax burden. So we'd look at the people in low income, and then we'd compare them, say, to the high income as an example, not as the only option. Could also be middle income to low income or middle income to high income. So what we're doing is we're taking a look and looking at the appropriate differences in the burdens. We would expect the high income earners to actually have a much higher burden than the low income earners, because going back to what Adam Smith said, they have a higher ability to pay. So the burden should increase. When we look at a progressive tax system, as the income goes up, so does the percentage. So this is the nutshell of a progressive tax system. And I'm going to make another video that demonstrates how a progressive tax works. But just know that the burden goes up as the income level goes up. The opposite of a progressive tax system is a regressive tax system. And that's one in which the burden does not take into account ability to pay and does not take into account income level. Now, something that is often brought up at this stage is a flat tax. And this is often touted as a fair tax, the only fair tax, but in reality, it burdens the poor more than it does the wealthy. When we look at how is this true, earlier I said that low income taxpayers don't have much of the way of disposable income because they are dedicating the income they do get to necessities, and they may not even have enough for all of them. They'd have to give some sort of ranking system for what are the most necessary of the necessities. So if we look at that, there is no actual disposable income. So if we were to have a flat tax of 10%, I earn $1,000 and you earn 100 million. Now let's go with a million. Let's not make you too flashy. So you make $1 million. So I earn 1,000, you earn $1 million. If we had a flat tax, let's use 10%, because again, that's math I can do on the fly. If I have a 10% tax when I'm earning $1,000, I have to pay $100. And if you're earning $1 million, you have to pay 100,000. And you're like, well, hey, that's fair. I've paid more money than you. We've had the same rate though. That's fair, right? Well, let's delve a little deeper. When it comes to the $100 that I paid, what would I have done with the money if I didn't hand it over for revenue to the state? What would I have done with it? Would I have bought a second home? Would I have, bought something frivolous? And I think that when you look at the fact I made $1,000 total, the answer would be none of the above. It would have gone to necessities. It wouldn't have gone to anything fancy. And in fact, my basic needs are probably not being met if I'm only earning $1,000 a year. So essentially, that $100 takes food out of my mouth. If I look at the person who's earning $1 million, you lucky sod you, you've given up $100,000, which was the same proportion. But what is your sacrifice? What is the sacrifice that you are in fact having as a result of the burden that you are bearing? And the answer is you still have $900,000 of disposable income. You have been able to have food on your table. You've had a roof over your head and you've had clothes on your bodies. Now, this doesn't get into the basic differences in price of those things among people of different income levels, but it does acknowledge the fact that you've got disposable income that didn't go to basic needs, and the person who is the low income taxpayer didn't. You took food out of their plates, off of their plates. You didn't take away their second home or that extra trip to Paris. You took away food. So when we look at the quotes that I generally have you think about when it comes to what is fair, the idea of a fair tax is where you have equality of sacrifice, not equality of numbers. And I even like to use a biblical phrase for this. If you're familiar with the tale of the widow at the collection plate, she put in a penny and people snickered at her, but Jesus turned and said that she has given more. than all of the other people because it was all she had. So we look at relative ability, we look at equality of sacrifice. That's the John Stuart Mill quote I'm thinking. I like to change it. Equality in tax means equality of sacrifice. I like to change it to equality of pain. You know, when we're what would be similar to a person who was earning $1 million? What would be a similar pain in tax as the person who earned $1,000 and had to give up 100? It certainly wouldn't be 100,000 because that's a rounding error. You know, that's a rounding issue. That's not taking food off their table. Which I'm not suggesting, by the way. This is a thought experiment, not a quest for social reform. Okay, so that is the end of our introduction to tax policy concepts. Thank you very much.